Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome back. And kind of a short week. Interesting. A lot of different things going on this week. Market's kind of quiet. Actually, there are certain areas that are doing very well. In fact, there are a lot of areas that are doing much better than expected, and a lot of things are going on in anticipation of a new administration and some of the things that they've already talked about doing. And we're going to be talking about that in great detail on Thursday night, January 12th. That's going to be Corporate College. You can go to my website, bullingtoncapital.com, to sign up for this workshop. And we're going to do it in two parts again. I'll come in the first hour. We're going to talk about individual stocks. As many of you know, I've been working on the website, the subscription website that's going to be coming out for trading individual stocks. And we'll be talking about that for the first, probably 30, 45 minutes. We'll take a quick break and let the people coming in ready to hear about the potential impact and outcomes for investors in the economy of this administration. That's actually what the main seminar is going to be about. So the pre-seminar, if you will start around 6:30. The regular seminar is going to start around 7:30. We're going to go, like I said, we'll go for 30, 45 minutes, take a break, wait for the others to get in, and then start the regular workshop. Actually, the official title is New Year, New President, New Risks and Opportunities. There are opportunities. There are lots of opportunities. In fact, there are a lot of stocks that are not fully valued, or even remotely close to being fully valued. And that's a good thing. That's a really good thing. The better thing is that a lot of things are going to start to happen. And in fact, many of them have already been happening. For the first time in over 8 years, GDP growth is above 3%. And by the way, that's still under this president's watch, not the future president. But I think that's going to accelerate. And you want to go to the workshop, we'll talk about why. And I'll also be talking about why on this show and shows in the future. So if you can't get to the workshop, don't feel bad. You can go to my website, listen to the radio program there. It's also on iTunes. Bullington Capital Report comes up on iTunes. And anyway, to reiterate, that's the 12th of January. The official meeting will begin at 7:30. We'll start the pre-meeting at 6:30. New year, new president, new risks and opportunities. And I think it's actually a pretty exciting time. The economy improving and market not being at bubble-like valuations, at least most stocks aren't. Some stocks are. In fact, the stocks that have done the best over the past couple of years probably not going to do that well in the future. Why? Because their valuations, sooner or later, company gets overpriced. In the meantime, the small, mid-caps, international emerging markets, those economies haven't done as well. They tend to follow whatever we do. Incidentally, the United States, with 5% of the world population, consumes over 20% of the world output. Think about that for a second. Yeah, that is not right. That's just the way it goes. So when things improve here, they actually improve everywhere. And right now, there are a lot of companies moving right now. Actually, I've had one of the best months that I've had in the past 4 years. Yeah, absolutely. The best month we've had in about the last 4 years, if you look at how the stock portfolios we manage have been doing. And so that's exciting. And I think we're just getting started. I think there's a really good potential that you have an excellent 3 or 4 years. That doesn't mean you won't have volatility. There's still stocks. They're still going to fluctuate a lot, actually. But I think the fluctuation, in the old days, we used to call it higher lows and higher highs. Every time the market comes down, it stops going down a little higher than it did the last time. When it goes up a little bit higher than it did before it stopped going up. So higher highs and higher lows, I think, is probably the theme for the next 4 or 5 years. Should be really interesting after that to see what happens. But over the next 4 or 5 years, there are lots of projects that can be done. They've already allocated money. They've already budgeted for it. Federal budget funds are now just being released. You're going to see employment figures jumping up. I'm really doubtful that interest rates will go up a lot. Why am I saying that? Well, there are lots of reasons. First of all, you've got a tremendous amount of government debt. You raise interest rates by a couple percentage points. So if you go from a sub 1% CD or a 1% CD to a 3% CD, that extra 2% on the debt that's coming due is going to increase by tens of billions of dollars the government's budget. Tens of billions. Actually, for every 1%, if you leave it long enough, it'll actually increase the expenditures by 100 billion. That's amazing. 1% increase. The reason that it doesn't happen right away, by the way, is that a lot of the debt the government has is revolving. So the treasuries that they sold 10 years ago are just maturing. Those are going to be invested at whatever the current interest rates are, but for 10 years, that was the rate on those 10-year treasuries. So I see what I'm saying there. When you have maturities that go from 1 year all the way out to 30 years, and you're not refinancing all your debt all the time, it's actually coming in steps. In fact, every year, a new class of securities will be 1 year. The 30-year treasury that was sold 29 years ago has only got 1 year to expiration. And if that makes any sense at all. And if it doesn't, don't feel bad. Just call me. I can explain it a lot easier over the phone or in a meeting. Something else we need to talk about. I go through this all the time. A little bit later in the show, we'll come back to it. But how much money do you really need to be able to retire? I talk to people all the time, by the way. So, and you know what's really funny is somebody has a conversation with me, and I'll talk about it on the radio, but there are at least 20 or 30 other people listening to the program who think I'm talking about them. Because we tend to think similarly. Not everybody thinks alike, but we tend to think similarly. So don't think I'm talking about you. If you hear me saying something along these lines, believe me, we all have similar thoughts. And especially when it comes to money and investing, there are different phases that you go through as an investor. And many people are in the beginning phases still because, you know what, they have lives. They have kids. If you have kids and a job, you don't have time to keep up with investments. I'm sorry, it's not feasible anymore. There are too many things going on to be able to pay a significant amount of attention unless that is your vocation. If that's your job, well, yeah, then you'll have time for it. But if you have a job that's not in the investment management business, it's wow. I feel bad for you. My heart goes out to you because I know you'd like to. I know everybody would like to keep up with everything and feel good about what they're doing, understand what they're doing, understand what's going on in markets, how their investments are going to respond, typically. But with a normal life, if this is not your vocation, it's hard because there's just so much data out there, and so much of the data is just wrong. But that's the sad part. I get corrected all the time now. And now I've gone to the point where I've tried to find at least 3 sources. Every time I hear something that I think is interesting, I'm trying to find 3 sources that I feel like are reasonably reliable, that I can verify whatever it is I've heard. So, and again, the chances of you having time to do that, pretty remote. Unless, of course, it is your vocation or you're retired and this is your hobby, which I think is probably one of the best hobbies you can have. Is investing, especially if you have a real sincere interest in it. If you got a sincere interest in it, you can figure it out. Might take you a little while, but you'll figure it out. And I'm telling you, most hobbies end up costing you money. This is one hobby that can actually make you money. That's one of the things I really like about it. It's a hobby that can make you money. And you might even decide at some point in time to take that hobby and turn it into a full-time vocation. You should definitely be attending workshops and seminars if you plan on doing that. Try to get as much information and knowledge as you can. That's basically what we all do. Go around, gather information, try to get the best that we can, and try to make sure that basically we're just doing as much as we possibly can to be able to make the best decisions we can. And if you do that, things have a tendency to work out okay. If you hear something that sounds too good to be true, probably is. So make sure you investigate that significantly, before you start putting money into something that sounds too good to be true. Something like guaranteed principal, stock market-like returns. No, that ain't happening. That was we hear this stuff all the time. And by the way, you just have to be careful. So I'll just leave it at that. You got to be careful. Realistically, I'm not even sure what to tell people anymore, quite frankly. There are so many scams out there. It's really difficult. It's incredibly difficult. Heck, I do this for a living. And every week I'm being sent things in email. Can you check this out for me? Now, those people, by the way, don't have any idea how difficult that is to check something out. They think that I'll know it right off the top of my head because they hear me talking about a lot of things on the radio that I do know off the top of my head, and they just assume that I'll know that. I got news for you. There are over 67,000 securities in a database that I have, over 67,000. I think that anybody is going to understand all 67,000 or has read about them. And they're creating new products from those 67,000 securities every day. So a lot of times, it takes longer to look up a product than it does to look up a company's financial statements, by far. What's a product? A product is an exchange-traded fund. A product is a mutual fund. A product is an annuity product. Those are all products, and they're typically made up of things that come from more than one asset category, and pretty difficult. Again, it's one of the reasons that if you're looking for advice on retirement, you really need more than one opinion. You need to talk to somebody about the taxes. That's important. I would talk to someone about the estate plan. That's important. And most importantly, I would talk to somebody who specializes in investments, because that's important. It is a vocation. Somebody who tries to do all three of those, it cannot do a good job. It's impossible. There are way too many things happening with estate planning laws, with the income tax, Internal Revenue Code. You can't keep up with just those two. Actually, one of those would be phenomenal. So investing is an occupation, but it also often, the way that it's marketed is we want to help you with doing the right thing for your family, or we want you to do the right thing for your retirement plan, which includes paying as little taxes as you can. So they're going to focus on taxes. And then they get the investment side. And by the way, the investment side is where they generally get paid. It's where they generally make the most money. Anyway, I got to take a real quick phone call here. If you'd like to call in today, 216-901-0945, 216-901-0945. And Dennis, you have a question about the market correction potential?
Yes. The market has been going up for quite some time now. And do you think we're due for a correction at some point? And, typically under a Republican administration, stocks tend to do less well than under a Democratic administration. At least history has borne that out for the last few decades. And I'm just interested in your thoughts on that.
Well, I think it really depends on what type of Republican you have in. You remember a guy named Ronald Reagan?
Yeah.
Do you know how well the stock market did under his tenure? It set records. Yep. So, it depends on the actual administration at the time. I think it has less to do with the party than it does their economic policies. And the economic policies, the ones that are being bantered about, really, and by the way, the market typically has a 10 to 15% correction every 12 to 18 months. So from that standpoint, might be a little bit over, not a lot, because remember around this time last year when you had the Brexit, everybody was all upset. There was a little bit of over a 10% decline during that time period. So can we have a correction? Anything can cause the market to go in correction. Trying to predict that ahead of time, that is just a loser's game. And so I really don't try to do that. I try to take a look at what's happening right now, and then I respond to whatever's happening. And that's the way that the vast majority of people who have done very well over the past 100 years, that's how they've done it in the markets. That's why I do it that way. Because when you want to figure out how to do something well, in my opinion, it's a good idea to go see what the other people that have done well before you have done, and if you can learn anything from that. And one of the lessons that really sticks out is don't anticipate. Be there and be prepared for anything. So if the market does go down, you've got an idea and you already have a plan in place. If the market continues to go higher, you have a plan in place. And the plan doesn't change. The plan does not change because of what the market does. You've already, that is part of the plan. You already know what you're going to do in advance. Does that make sense?
Yes, it does. If you have the stomach for the ups and downs.
Yes, exactly. And you can determine how much, because you won't be able to do it without any ups and downs. That's never going to happen. You'll always have ups and downs. But you do have some control over the magnitude, over how much volatility that you're going to put in place. In fact, we're working on a couple videos that I'm going to put up on my website to help people, because it is a lot easier than people think it is. It is a lot easier. The vast majority of people get caught up trying to predict what's going to happen, and then when they get their nose bloodied a few times, they quit. I think this is just impossible, and just give me a 3% CD and I'll be fine. Yeah, that's really not the way to do it. It's not the way anybody that's been successful in the markets has done it. There is another way. You try to define how much volatility you're willing to put up with in an effort to make money on your investments, and then you restrict the assets so that if you do get a big 50% drop like 2008 and 2009, that you don't go beyond that limit, or you don't go much beyond that limit. And that way, if it happens, you're already prepared for it. And hey, I got to take a real quick commercial break, Dennis. Thanks for calling. But you're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these messages. And we're back. Hey, if you want to call in, 216. I just went blank there completely. 216-901-0945. 216-901-0945 if you'd like to call in and ask a question. And we're going to be talking about opportunities and risks coming up over the next 4 or 5 years in this administration. And I really believe that we're going to do reasonably well. I really do. Looking at all the talk about the people that are thinking about taking posts, influential posts in this new administration, I'm encouraged. I'm encouraged by a lot. So is the stock market, by the way. I want you, probably go down and correct just because I said that. But the reality is, we're on pretty solid footing. If taxes do in fact get cut, and if in fact they spend all that money on infrastructure, it's going to work. It'll work. And it'll put off the day of reckoning for at least another 4 or 5 years. Give the stock market some room to breathe. A lot of stocks have not done that well over the past few years. A lot of stocks. You look through the Russell 3000, there aren't a whole lot of stocks at their all-time highs. And when you look at their valuations, it's even better. They're selling at discounts to valuations. In fact, the last seminar, I have to apologize. I put out a list of banks. Some of them were actually just too small to buy directly on an exchange. So I've got another list. I'm going to send this out to anybody that went to the workshop, and anybody that wants it that's listening to this program. Just give me a call or send us an email. I'll send you a list. These are banks that are in the Russell 3000 that are undervalued. Banking is one of those industries that should benefit fairly significantly from the change in administrations. So, and I'll actually talk more about that next week when I've sent this out to everybody that came to the workshop. And the reason it's not out already is I've got the report done, but I have to put all the symbols back into a spreadsheet because right now the report is in a PDF. So that'll be done by Monday, and you'll get that. You'll be able to go in if you wanted to. I think this makes a really good idea for a portfolio. You can do this through a firm called Folio Investing. I use Folio Institutional. That's the institutional side. But with Folio, you're able to take a basket of stocks and buy them with one click, kind of the way you would buy a stock. They do it without commissions. You pay one flat fee for the entire year, and you have unlimited transactions through their trading windows. They have 2 trading windows a day. And you can have you can rebalance your portfolio. They'll track your performance. They track your performance in pieces. So if you wanted to create this particular folio, that's what they call it, short for portfolio, you would import these lists from the spreadsheet, or the stocks in the list from a spreadsheet. You hit synchronize, and however much money that you had allocated to that particular strategy will be invested in those stocks. Whoppa! No one else does that, by the way. The other firms can't do it. They don't have the technology to do it yet. These guys are the first. And I think it makes perfect sense. Now, I get calls a lot. Well, what do you think of XYZ stock? Well, I got to tell you, I'm not a big fan of buying an individual stock that I don't know a lot about and calling into the radio station. It's fun, but realistically, to know a lot about a company, it's going to take you a couple of hours. Reading about the company, the management's discussion, looking at the financial statements. If you look at the financial statements and you notice that something's really wrong right away, well, you can stop looking at it. There's no need to continue looking at that company when you notice one of the easy things that is a red flag. Okay, that part you can just, that makes it a little quicker. But assuming that it's within a range of normal, it takes a very long time then to go down and dig through and pull out all the details you're going to want to look at if you're going to make a long-term investment. It's one of the reasons I like to trade a little bit. It's not as the research is actually not as intense. In fact, it's nowhere near as intense. So the trading is not the same thing as investing. People get that confused a lot. Those are 2 different activities. Most of your billionaires do not trade. They can't. Most of your mutual funds that have over 500 million in assets in them don't trade. They can't. They're too big for that. They would actually start making the stocks that they're buying and selling go up and down by themselves. So, at any rate, I've got a question from Don. Don, you have a question for me?
Yes, I wanted to know where I can find the proper factor for making my required minimum distribution on my IRA.
There are a lot of calculators for that online. If you go to Google and you just type in RMD calculators, there are a ton of them out there, and the IRS has a table at irs.gov. So those would be 2 places that you can get that information, like lickety split.
What should I call the IRS?
If you'd like to hang on hold for an hour or so, that would be a good idea. If you don't want to do that, you can just go to Google and type in RMD calculators. And in fact, I'll do that right now because I am telling you, a ton of them will come up. And I've got one in my office. It's a hang on one second.
Well, should I call your office?
You can. We're not actually that's something that your tax person is supposed to do, actually. But we have to. I can tell you what the numbers are going to say, but you still have to verify that through someone else. But
okay. Well, what is the website then?
There are tons of them. There's actually one from FINRA that I just found. Required minimum distribution calculator. And so if you go to Google and type in required minimum distribution calculator and then type in FINRA, FINRA, it'll bring you right to FINRA's calculator. And it's pretty, that's a good one. It looks pretty easy now that I pull it up. So not too bad. And you feel free to give us a call, if you really want help with that. Now, here's something you need to keep in mind. If you do this for one particular IRA, you have to do this for all of your IRAs. It's not for one.
Oh, yes, I understand.
Yeah. And you can take all the money out of one IRA, though.
You total up your total IRAs, but you can make the withdrawal from just one if you wish.
Right, exactly.
So now, do you type in the letters RMD, or do you type in the full word required minimum distribution?
You could probably all I typed in was RMD, and let's see. Yeah, this is funny. I typed in RMD FINRA, and it brought me right to it. So RMD and space FINRA, and it brought me right to FINRA's required distribution. It came up first on the list there.
There's nothing else other than that. Just RMD space FINRA.
Yep, that's all I did. And
okay, I'll try it.
Okay. Well, thanks for calling.
Thank you.
Sure. Bye. And we do this for an awful lot of people. By the way, most of your brokerage firms will do that for you. And when we actually have this process where we work together with the brokerage firms and your tax preparers. Melissa King in my office, she's the one that's actually in charge of that, and she gets started in September. So she's pretty glad when the end of the year comes and everybody's already taken their RMDs. You do not want to forget to take that. If you forget to take that, you can pay big penalties on that. There's a huge amount of extra tax that you have to pay. Or not extra tax, a penalty on top of the taxes that you have to pay. So, yeah, that's something you really want to pay attention to. You've got until the end of this year to make sure you get that out. You don't have to take it you don't have to take it until December. I would not wait to wait. We have people, we used to have people that used to wait until December 31st. I need to take my district. Nope, you have to start it earlier than that. You can't get it out if you call that last day. It's just not going to work. Okay, so don't do that to yourself. Make sure you minimally start that next week, that whole process. And you have to remember all of your IRAs. That's a big deal. You got to remember all of your IRAs. Incidentally, we are working with Morningstar. Morningstar actually reached out to my little firm. I'm surprised. Yeah, because I guess we're not as small as a lot of others, but we're actually in a test group, a beta group, where Morningstar is going to set up portals, basically a website for our clients so that they can add whatever accounts they want to add to the accounts that we manage. Because right now, we pull in all the data from the two vendors that we use, or custodians. We use Fidelity Investments. We use Folio Investing. And we can pull that in to create reports to show how the assets are allocated, the history of the securities in the accounts, and all kinds of other really good stuff. Well, now they've actually reached out to us. We've agreed to become part of their beta testing group. And they're going to allow us to make this available to our clients, and our clients will be able to add any other accounts that they would like. So if they're interested in tracking their spending, if you're interested in tracking your spending and having a website set up to help you do that, we'll be able to do that. I'm not sure who they expect to do the service work on that. Whether it's going to be them or it's going to be self-serve. I have an idea that's probably going to be a combination. We've tried to do this like 3 or 4 times, and the tech support for the products was so intense that we couldn't do it. Every time somebody's password or user ID changed at a bank, and I have a Chase account that drives me nuts. Those guys are constantly changing their stuff. It's for our safety. I get it. But man, I have to go back in and reset it up, and it doesn't play nice with any of the other aggregators. That's what they call them, the account aggregators. So it became such a nightmare, and we're trying to provide tech support to a product that we didn't create. That's why we have stopped doing it. Well, we're going to let Morningstar have a crack at it and see how that goes. So I think it's going to be a pretty cool tool, especially. And what I'm thinking is happening is we're just going to bring on the accounts that we manage for people, and then they will have the option to bring in their own accounts. So pay pay attention to the show. I'll keep you posted on how it's going. They're really not going to roll it out to us until the beginning of the first quarter next year, so sometime in January. And I think that's a really good idea. I like the idea of being able to track your spending, being able to track your investments all in one place. Quite frankly, it just hasn't worked that well. Even with all the great technology that's out there, that particular piece of the technology has not been made ready for prime time. And hopefully, Morningstar is a multi-billion-dollar firm. Hopefully, these guys will get it right, because the other ones so far have not done a good job. It's been incredibly difficult to work with. So, knock on wood, that's a coming. And maybe, hopefully, by the time the next seminar comes up that we've been talking about earlier today, I got to go back to where that is. January 12th. That's a Thursday night, by the way. Thursday night, we're going to be talking about new year, new president, new risks and opportunities. There are lots of opportunities. But you look at how the steel stocks are doing. It is unbelievable. I'm getting relatively close to a commercial break. I think I have about 3 or 4 minutes. So I won't get into the stock. I want to talk about stocks in the very last section. I'm going to try to do that every show from now on. But I can tell you right now, there are certain stocks that are moving really fast, whose valuations are very low, who seem to be getting a lot of support from Trump's administration. You get financial support from an administration. Those guys wield big sticks. They can move boulders for you with a stick. Yeah, it's called a lever. They're going to use the lever, and they're going to let some leverage go. And I think if they follow through on half of what he said he was going to do, these guys are going to have a big year, and they're already off to a good start. So again, you want to pay attention. That workshop's the 12th of January. We've got a bunch of videos coming out soon over the next month or so. The videos that we've had in the past, there are only a handful of them. I wasn't really happy with the way that they were produced, and nothing to say about the people that are producing them, because it's me and my group that are producing them. But the technology, I think the technology has improved dramatically. We built this thing called a light board, thanks to Gary, the guy that does the trading. Go to my website and see his picture there. And this guy built this light board. It's a big glass pane that's edge lit with LED lights and a big frame. And we're trying to get the lighting right to be able to see me writing on the glass pane with a fluorescent marker. When you write on the glass with a fluorescent marker that's been edge lit with LED lights, it pops, it glows. The writing actually glows. What's cool about that? Well, actually, you get to see my facial expressions. You get to hear the tone of my voice and the reading. Now, if you're looking through the other side of the glass, it's actually backwards. But when you video that and you flip it, you're now looking at the text the same way that I am. It looks like the text that I'm looking at as I'm writing it. So I think that's going to help us out quite a bit with being able to describe a lot of that topics that we've been talking about here since I started this show. And especially when it comes down to retirement planning. That's a big deal. Retirement planning is a huge deal. I mean, you don't want to run out of money in retirement. And it's one of the reasons people are buying these guaranteed products that are paying out the yin-yang. And some of them have total fees of like 10 to 15%. That is incredible. How are you expected to make any money that way? You won't. In fact, if you die with a product like that before you're out of the quote-unquote penalty period, there's this thing called a market value adjustment that comes in. That's not even considered a contingent deferred sales charge. So they don't really talk about it much. They have to disclose it a little bit in its prospectus, but you could actually end up inheriting, or your beneficiaries inheriting less money than you've invested, even if you've never spent anything. And for years, sometimes those things hang around. So it'll wipe out an enormous amount of gain. As we come back, we'll talk a little bit about how you can avoid that and a whole bunch of other stuff. This is Bill Bullington, 1420 The Answer. Be back after these messages. And we're back. I did it again. I forgot. Well, we're going to actually spend this last section just talking about individual stocks. It has been over 2 years since the market's been conducive to making money using trend following or momentum-based strategies. And that's a long enough time period to convince an awful lot of people that it's never going to work again. And I got news for them. Markets tend to be very cyclical, and the cycles tend to stay for a lot longer than you think they can. And there's really no set time period that they typically stay for or leave for. But looking at what's happening in financial markets, I've got 53 stocks that I have marked, that I have pointed out over the past month, who have good underlying fundamentals, who also have very good looking price trends. So when you've got attractive stocks with good, strong price trends, that's something to take up and sit and notice. All right. I don't even know how to describe that. You should pay attention. And it's a good thing. I'm really excited about what I'm seeing. It's been a very long time. You don't understand. It's been a very long time since you've had this many high quality companies with valuations as low as they are in a positive trend. When you look at the chart, if you held it up to a 5-year-old and say, what direction does that look like it's going? And they say up, then you know a trend exists. That's exactly what we're talking about. So it's one of the reasons I'm kind of upbeat. We've had a lot of head fakes over the past couple of years. You get a 3 weeks or 4 weeks where stocks get strong and then they turn around and go right back down again. Boy, is that frustrating. But I think that this thing might have some teeth, might have some legs. Might take by the way, this is the best time of year typically now through the end of January. For the last few years, December has been a phenomenal month. But, so you might want to pay attention. Now, if I feel like I always need to preface all this by saying, look, if you don't have deep interest in financial markets, you need to get with some strategies that somebody's going to run for you, that you don't have to really pay too close attention to. That's what we do at Bullington Capital. And we've got strategies that you do not have to pay that close attention to. We're working on bringing others out. Actually, Russell's got some strategies for RIAs, and they do it on a much larger scale. They're more diversified than the ones that I use. I use concentrated portfolios. The bank stocks, they're under 50 stocks there. So if you were to overweight that, which you can do, by the way, with as little as $1,000, you could have $1,000 and say, look, Bill, because you're my advisor and I cherish this relationship, I want to have a little bit of money in those bank stocks that you talked about, but I don't want to put more than 3 or 4% of my money in there, or 5 or 10% of my money in there. No problem. I just look at your account, figure out what 5% is, allocate to those bank stocks, hit click. It synchronizes and puts all 50 of those stocks, or however many is in that particular portfolio, in that dollar amount, and it will buy fractional shares so that 100% of it is invested. How cool is that? That is awesome. And we're one of the few firms in the country that'll do that for you, because for most people, they haven't figured out how to get that done logistically. And I understand it is, without the technology behind them, it's really difficult to do. So that's one of the ways that we are significantly different than most of the other financial investment advisory firms around the country. We will build a customized portfolio and run it for you. The other way, and that's the same kind of thing that Russell's doing. This actually is going to be my first foray into using Russell as an investment advisor to an investment advisory firm. It's a new program. They're going to do this they do it on a much larger scale. They watch money managers. They move money managers in and out. One of the big problems with a money manager is when they get very successful, so much money comes into their funds that they can't continue to do what they were doing when they were younger, smaller, more nimble, and the big performance goes away. And that's been one of the frustrating parts for me in my career, is following these firms who got to be humongous firms and watching how their performance tends to subside. Their outperformance tends to subside. It's pretty rough. It's rough even when you know what you're doing, by the way. The concentrated portfolios, they'll underperform for 2, 3 years, 4 years in a row sometimes. That's tough to stick with. If you don't think it is, try it. It's a bear. Anyway, back to the Russell thing. These guys are going to work with the bigger firms. They're going to use more of a diversified products, funds basically that they create, pulling from the list of investment advisory firms out there that are bigger than I am, that tend to deal with really large accounts. And so that's kind of exciting. You'll be able to do that through Fidelity. And Fidelity, incidentally, if you are going to trade stocks, I would either use Fidelity or Interactive Brokers, one of the two. If you're going to trade stocks, those are the two. If you're going to have a more traditional portfolio where you're going to buy some large cap, mid cap, small cap, international emerging markets, short-term bonds, intermediate-term bonds, you might want to just go with Fidelity. That's why we're going with Russell there. I still don't believe in buying market cap weighted indexes. I just have an incredibly difficult time doing that. Like the S&P 500. I hear this all the time, and they point out how well it's done. Yeah, well, it's done well over the past 5 years, but go back to March of 2000. See where the index was in March of 2000 and tell me you're happy about those returns. You go to March of 2000, it's only up, it's up less than 5% a year for 16 years. And for 13 years, it was negative. So if you are happy with a 13-year negative return, then by all means, invest in market cap weighted indexes. I hate that. I refuse to do that. My clients can't afford to go 13 years being negative. So I don't care what its gross return was. It doesn't matter. If you're going to go through a 13-year negative time period, you're not making any money. I mean, think about that. How long is your retirement going to be? Average retirement is close to 30 years. Yeah. So if you went for 13 years and made nothing, 13 years and were negative, I just have to avoid that. So if its long-term average return is, even if it's higher than mine, and most of the strategies, they're not. Over a 4 or 5 year time period, toss a quarter. Toss a quarter as to whether or not you'll beat the market over the next 4 or 5 years. That's actually almost ridiculous. When people start talking about long-term in the stock market, they really don't have a good idea of what they're talking about. Long-term is 5 years and longer. Long-term is a minimum of 5 years. So long-term for an awful lot of people is the last 2 or 3 years. And that's, they don't even know that they're doing that, by the way. They don't have any idea that that's the mistake that they're making. They're looking at the 1, 3, 5, and 10-year track record and thinking, now that's pretty good. What they don't realize is more often than not, the last 2 years have been very good for that fund. And a lot of those fund managers just got lucky. Or if they were talented and they were just doing better because they had a small fund to deal with, the money comes into that fund and that track record is not going to be repeated again because he's just gotten too big. And it's why I left. It's why I started my own firm. It's why I have those more concentrated portfolios. If you ask me what I'm going to do, I'm going to show you the same models I have in my accounts. And this thing about the banks, that's to be able to overweight. And yes, I'm going to add that to my account. I have not. I always let you guys know before I do something like that because I can get in trouble for putting my money in first. But so I think it's a good idea. I think it's a great idea. Banks poised to rebound. There are a lot of. I was shocked at the number of banks that were selling below 2 times their book values. Back in the late 90s, they got as high as 5 times. If you buy something under 2 and then it goes to 5, that's a lot of dough, especially with a dividend. And that was that was the criteria: less than 2 times book, less than 3 times sales, and pays a dividend. So I was amazed that there were that many banks out there that met the criteria. And this is part of what we'll be talking about for the next few weeks and at the seminar that we've got coming up. You can feel free to show up at that seminar, ask a lot of questions if you want to. You can actually email questions too if you'd like to send me emails. But seminar on the 12th, we'll talk a little bit more about the banks again. I don't think they're going to go up 150 or 200% overnight. I think that takes the next 2-3 years. I think a little legislation to help them out, to free them up a little bit, is going to help. Now, whether or not they repeat the same mistakes of the past, that's another question. I think it's been recent enough, though, that, banks do tend to learn from their mistakes. We all do, hopefully. Yeah, and I think it's the last little escapade is recent enough and still fresh in their memories that they probably won't repeat that mistake again. Now, they'll find another mistake to make somewhere along the line because that's just the way things work. But I think we won't make that mistake again for quite a while. I just have been told I got about 30 seconds left, so I guess I should tell you guys, go to my website to sign up if you'd like to. It's bullingtoncapital.com. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, everybody. Good luck and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.